demand.
Good afternoon, ladies and gentlemen. This is Clueless 8, and this is a live recording of market movements during Janet Yellen's post-Fed rate hike press conference, just to give a little flavor on how markets react and what they do. Thank you, and thank you for all the support.
The neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary if the economy were operating near potential, is currently low by historical standards and is likely to rise only gradually over time. One indication that the neutral funds rate is unusually low is that U.S. economic growth has been only moderate in recent years, despite the very low level of the federal funds rate and the Federal Reserve's very large holdings of longer-term securities. Had the neutral rate been running closer to its longer-run level, these policy actions would have been expected to foster a much more rapid economic expansion. The marked decline in the neutral federal funds rate may be partially attributable to a range of persistent economic headwinds that have weighed on aggregate demand. Following the financial crisis, these headwinds included tighter underwriting standards and limited access to credit for some borrowers, deleveraging by many households to reduce debt burdens, contractionary fiscal policy, weak growth abroad coupled with a significant appreciation of the dollar, slower productivity and labor force growth, and elevated uncertainty about the economic outlook. Although the restraint imposed by many of these factors has declined noticeably over the past few years, some of these effects have remained significant. As these effects abate, the neutral federal funds rate should gradually move higher over time.
As you can tell, this is the daily chart. I'm monitoring that also as we move in real time.
Projections of appropriate monetary policy. The median projection for the federal funds rate rises gradually to nearly 1.5% in late 2016 and 2.5% in late 2017. As the factors restraining economic growth continue to fade over time, the median rate rises to 3.25% by the end of 2018, close to its longer-run normal level. Compared with the projections made in September, a number of participants lowered somewhat their paths for the federal funds rate, although changes to the median path are fairly minor. I'd like to underscore that the forecasts of the appropriate path of the federal funds rate, as usual, are conditional on participants' individual projections of the most likely outcomes for economic growth, employment and inflation, and other factors. However, the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. Stronger growth or a more rapid increase in inflation than we currently anticipate would suggest that the neutral federal funds rate was rising more quickly than expected, making it appropriate to raise the federal funds rate more quickly as well. Conversely, if the economy were to disappoint, the federal funds rate would likely rise.
Now keep in mind these are the S&P E-minis, so that's where the activities lies as fast money goes in and out. You can clearly see here that the 2057 level, the 2057 level is a key mark. Got rejected there on the 50 SMA on the daily, so we need to take that out fast and furious, and at that point we're going to engage 2073, and it's going to happen fast. This pattern symmetry that you're looking at, in my opinion, will get done, and of course there's going to be zigzags in the middle. So stuff that I do, stuff that benefits all of you guys and girls.
Financial conditions, and should reduce the risk that the federal funds rate might return to the effective lower bound in the event of future adverse shocks. Finally, in conjunction with our policy statement, we also released an implementation note that provides details on the tools that we are using to raise the federal funds rate into the new target range. Specifically, the Board of Governors raised the interest rate paid on required and excess reserves to 0.5%, and the FOMC authorized overnight reverse repurchase operations at an offering rate of 0.25%. Both of these changes will be effective tomorrow. To ensure sufficient monetary control at the onset of the normalization process, we have, for the time being, suspended the aggregate cap on overnight reverse repurchase transactions that's been in place during the testing phase of this facility. Recall that the committee intends to phase out this facility when it is no longer needed to help
the interest generated between focused and disciplined member traders like our good loyal members who are active almost every day, Savvy Trader, VIX, and all good people, and many others will benefit tremendously from these live trading rooms that infrastructure has been put in place. So obviously, I'm just showing you one platform here. That's the Think or Swim. The algo charts are a different story. I'm trying to see if I can record that simultaneously. These are the things that keep me in the game, both on the long and short side. And as you all very well know, my mission statement is simple. Whatever I can do to benefit my members and traders and help myself is really is my sole purpose. After all, this is a joint effort, and it's a symbiotic relationship that we have. Thank you for listening.
Marty, question with the Associated Press. I guess the word is finally. And we have asked you for so long, why were you delaying? So I'll ask, given developments around the world, there's still weakness, and the inflation is still nowhere near your target. What made you say do it now? Some have said it was because you feared a lack of credibility if you didn't move. Did that play a role in your decision?
We decided to move at this time because we feel the conditions that we set out for a move, namely further improvement in the labor market and reasonable confidence that inflation would move back to 2% over the medium term. We felt that these conditions had been satisfied. We have been concerned, as you know, about the risks from the global economy, and those risks persist. But the U.S. economy has shown considerable strength. Domestic spending that accounts for 85% of aggregate spending in the U.S. economy has continued to hold up. It's grown at a solid pace. And while there is a drag from net exports, from relatively weak growth abroad, and the appreciation of the dollar, overall, we decided today that the risks to the outlook for the labor market and the economy are balanced. And we recognize that monetary policy operates with lags.
So on this 15-minute recording, as you can tell, Ms. Yellen is speaking in the background, and I'm just showing this to everyone in real life. A lot of the backstage stuff that goes on before I deliver my content. So I'm sure all of you are going to appreciate and realize how powerful some of these inflection points that I keep on showing. They are all of my charts that are generated by Think or Swim, Quad, which is the algo HFT chart thing that I've been promoting, which is a tremendous tool, as well as the other platforms that I use.
We have indicated that we will be
now this is a daily chart, so again there's a lot of nuances in the middle. We don't know whether we're going to get up here in the overbought territory, which I think will happen, but if I switch this over to the 1 hour, you're going to see that we are certainly getting overbought. So this is a quicker version of this thing here. This candle needs to be respected. This is powerful. This is a hammer reversal. That's a significant amount of money. You can see that through through this bar here, there are 363,000 contracts that are being covered or bought. Now, anything can change anytime. We know that, but you know, you got to respect what's going on here. Now, if I switch this over to the 4-hour, if I switch this over to the 4-hour, you can see here that we have a kind of couple handle formation. We'll find resistance at 2057, and of course, you know, we could very well be looking at this downtrend engagement 2069. So, you know, all these different time frames you can see here on the 4-hour chart, which is basically 2 segments of a trading day. We are at almost 500,000 contracts here that are on the buy side, right there. I'm going to put it back on the daily. It's cleaner for swing traders. You know, that's obviously the play. As long as these don't collapse, we're in the trade. We got to watch the volume candles too. A higher volume candle than the earlier part of the day. I'm sorry, 12:40. Yeah, yesterday would be nice. We need to see a ramp up on that. Another thing that I notice here, which is the open interest here. Look at the open interest rising. This is key. When we crashed here, you could see the open interest crash down to 0.77, right? 0.7 million. And look at the open interest now. So traders are bulking in. You know, I mean, this is you know, I'm just showing you some fine lines of doing this. And when we do the live trading session and people want to learn about this stuff, the group sessions are available, advanced group coaching sessions, as well as single. And again, I'm here to help. I devote my time. You know what I got to do, guys. I'm going to leave this pattern here. I'm not going to post any charts right now. A lot of content have been produced out there. Work on it.
So a further decline in the unemployment rate and strengthening of labor market conditions will help to erode those margins of slack.
Because unless you understand the sequence of how these things are happening, you can't just flip around just trading stocks.
And so
I'm going to show you a quick thing of the TF. That's your Russell 2000. This is powerful. This is powerful. That's the reason why the USO's oil will turn. And I think they're a great... now we should be up about 200 points the way things are going. But the Russell 2000 is looking at, on the daily side, at least 1156. Aggression is needed at market lows, like a retest of the downtrend line here. You cannot be sitting there pretty saying, you know what, I'm waiting for the perfect moment. There are no perfect moments.
And worry about the fact
and believe me, I know.
Interest rates at 0, we have less scope to respond to negative shocks than to positive shocks that would call for a tightening of policy. That is a factor that has induced us to hold rates at 0 for this long. But we recognize that policy is accommodative, and if we do not begin to slightly reduce the amount of accommodation, the odds are good that the economy would end up overshooting both our employment and inflation objectives. What we would like to avoid is a situation where we have waited so long that we're forced to tighten policy abruptly, which risks aborting what I would like to see as a very long-running and sustainable expansion. So to keep the economy...
There's about 1.5 minutes left to this thing, and let me show you something here. You don't want to mess around with this candle. That's all I gotta say, okay? Don't be a hero. This is powerful. Look at this. This is billions of dollars of short covering and massive movements of inflow inside the thing. It doesn't mean we're gonna hit new highs. We're traders. We want to make money. Respect it. Stop being dogmatic.
John Hilsenbach from
This is my first sell point right there, 2070 on the E-minis.
About gradual increases in that section. The committee says that it will carefully monitor progress, actual and expected progress on inflation. That's going to read like some kind of code to a lot of people on Wall Street. Can you describe, what do you mean when you say carefully monitor, and specifically with regard to what you do next, do you need to see inflation actually rise at this point in order to raise interest rates again?
Well, we recognize